Hey traders, this is Mike Sir here. As I mentioned earlier this year, I've been spending more of my time on trading the cryptocurrency markets due to the incredible amount of trading opportunities in that market. However, it's a very volatile market where prices can fluctuate wildly, and many of you have sent me many requests to teach you how to trade the crypto market. Well, I'm happy to announce that I partnered with Delta Exchange, a leading crypto derivative exchange, to offer you a free course on how to make money from trading cryptocurrencies. They are a sponsor of this 4-part video series where I will show you the tools and strategies that I use on a daily basis to analyze the cryptocurrency market. So let's get started. In this part 1 video series, I'm going to first of all introduce you to derivative trading. Now, a derivative is a contract between two or more parties whose value is based on the underlying financial asset. And this asset could be a stock market index, such as the S&P 500, a commodity such as crude oil, a company stock such as Apple, or in this case, a cryptocurrency such as Bitcoin. Now, in a derivative contract, there is a buyer and a seller who have opposite opinions and wager on the future trading price of the asset. So, for example, in the case of derivatives in the cryptocurrency market, the underlying asset can be any cryptocurrency token and not just Bitcoin. It can be Ethereum, Binance Coin, Solana, or even altcoins such as Shiba Inu. Basically, a buyer and seller would enter into a financial contract to speculate on the future price of a specific cryptocurrency at a future date. Now, the two sides would agree on the purchase and selling price for the cryptocurrency on a specific day, irregardless of the current market price. Now, if the price of the cryptocurrency goes up in value by a future date, the buyer of the derivative contract would make money, while the seller of the contract would lose money. In the crypto derivatives market, there are 3 different types, and they all differ based on the conditions of a contract. So let me explain each of them in detail for you. Now, the first type is called a futures contract, and you may have heard me talk about this type of derivative in past videos. Now, they are essentially legal agreements to buy or sell a particular cryptocurrency at a predetermined price at a specified time in the future. So, for example, the buyer of a futures contract is taking on the obligation to buy and receive the cryptocurrency asset, such as Bitcoin, when the futures contract expires. The seller of the futures contract is taking on the obligation to provide and deliver Bitcoin at the expiration date. So basically, crypto futures are financial contracts that obligate the parties to transact a crypto asset at a predetermined future date and price. Here, the buyer must purchase or the seller must sell the crypto asset at the set price, regardless of the current market price at the expiration date. These contracts are directly executed on a regulated crypto exchange such as the Delta Exchange. Typically, futures contracts are used by 2 categories of market participants. One are the hedgers, who are the people who already own Bitcoin or mine Bitcoin and want to protect against the decrease in value of their Bitcoin holdings. The other, who are the speculators, they want to make a bet on the future price movements of Bitcoin utilizing futures. The second type of crypto derivative is called options contracts. And again, you may have heard me talk about crypto options in the video where I profiled how a Bitcoin trader made over $58 million trading Bitcoin options. Now, Bitcoin options are basically an agreement between 2 parties to facilitate a potential transaction involving a cryptocurrency at a preset price and date. Now, the major difference from futures contracts is that option contracts give traders the option or the choice, but not the duty, to purchase or sell a crypto asset at a defined future date and price. So in simple terms, the buyer of an option contract is buying the right, but not the obligation to buy or sell a cryptocurrency asset at a predefined price and by a predefined date. To keep things simple, I'm only going to focus on option buyers rather than sellers of option contracts for now. The third type of derivative in the cryptocurrency market is called perpetual contracts. Now, they are contracts very similar to futures contracts, but the biggest difference is perpetual contracts have no expiration date or settlement. Now, the benefit is it allows traders to be hodlers and hold onto their crypto asset for an indefinite amount of time. Now, in addition, you can still trade these perpetual contracts in and out. You just don't need to worry about the contracts expiring. Now that you're familiar with the type of derivative contracts to trade, which underlying crypto asset do you want to trade? Well, the most popular is, of course, Bitcoin. And as I mentioned in previous videos, Bitcoin is like the gold standard of the crypto market. It is the biggest coin by market cap and the most well-known cryptocurrency. So if the Bitcoin price is up, then most of the other coins are up as well, and vice versa. Another coin considered the silver of the crypto market is Ethereum, and is the second biggest coin by market cap behind Bitcoin. In addition, most crypto derivative exchanges will have the top 10 to 20 most popular crypto tokens to trade, so there are lots of options to choose from, such as Binance, Ripple, Cardano, Terra, and Solana. Typically, most of the derivative contracts that you will trade will be the value of the crypto asset, such as Bitcoin, to be relative to Tether token, which tracks the value of the US dollar. However, there are some derivative contracts that you can trade with that track the value of a crypto asset relative to Bitcoin or the Ethereum price. If you want to trade any crypto derivative contracts, all you need to do is open up an account with a regulated crypto exchange such as Delta Exchange, as this is where all the contracts are directly executed. Now let me take a few minutes here to outline why I've decided to partner with Delta Exchange. Now they built one of the most liquid and trusted global currency derivative exchanges, run by the founders who bring expertise across financial markets, derivative trading, product and engineering from companies including Citigroup, UBS, and Hotstar. Now they're well financed by investors such as AAVE, Coin Fund, and Kyber Network. They have an incredibly comprehensive product offering with more than 100 crypto derivatives to choose from and are number 2 in crypto options trading volume globally. Now, they're currently offering a special promotion for only my viewers. So if you sign up for an account today, you'll receive a 10% discount off any trading fees. In addition, try options trading on the Delta Markets platform and get up to $100 cash back on your first options purchase. Now click on the link in the description box below to sign up for an account today. Before we outline the benefits and risks of trading crypto derivatives, please take a moment to like this video, hit the subscribe button if you haven't already, and tap on the notification bell. You will be alerted when the next video comes out for this 4-part video course series on how to make money from trading cryptocurrencies. Okay, let me outline the benefits of trading crypto derivatives for you. Now, the number one reason why traders love trading crypto derivatives versus trading the actual coins or tokens is leverage. Most crypto exchanges outside of the US offer leverage as high as 100 to 1 on most cryptocurrencies. So if you are consistently making money in cryptocurrencies and are able to manage risk properly, this will help compound your returns dramatically. On the other hand, the high leverage that crypto derivatives offers is also a major risk. Now, we already know that cryptocurrency prices are extremely volatile, and if you add a high leverage component to it, then you're basically adding additional risk on top of high risk. Now, this is a reason why you should only trade with money you can afford to lose if you are trading for speculative purposes, as you could lose money very quickly if a position goes against you. Another benefit that I already mentioned is that if you already own the cryptocurrency coins and are a hodler, meaning that you believe in the long-term value appreciation of, let's just say, Bitcoin and never want to sell, you can use derivative contracts to hedge your downside risk. Now, this is an important benefit because crypto prices can fall 50% or more even if they do go up over the long term, and it can help minimize the stress of holding crypto assets. In addition to allowing you to hedge the downside risk using crypto derivatives, you can speculate and profit on crypto assets such as Bitcoin or Ethereum declining in value by selling derivative contracts. Now with crypto coins or tokens, there's no way for you to profit on the downside. So with crypto derivatives, you can make money whether the crypto assets go up or down in value. Lastly, derivative trading has low transaction costs because they are considered risk management instruments and generally help to reduce market transaction costs, especially if you compare to trading the actual coin or token. Thanks for watching part 1 of the 4-part video series of how to make money trading cryptocurrencies. Now part 2 will be released next week. Please make sure you hit the subscribe button and notification bell so you will be alerted when the next video will be released. I'll see you guys in the next video.